All right, welcome back, everyone, to this Explainers segment. Today, we're really setting the stage for a deep dive into a massive new chapter for our recurring main characters in the global business space, Sun Pharma and Organon. You know, the tectonic plates of the pharma industry, they're constantly shifting, but every so often, a deal drops that literally redraws the map. We're going to break down the exact anatomy of this deal, completely unpacking the strategic masterpiece and, yeah, the massive risks hidden right there in the numbers.
So think about this for a second. How do you instantly double your company's size, jump straight into the global top 25, and somehow acquire $8.6 billion of debt in a single afternoon? I know it sounds like total hyperbole, but that's the exact reality of the situation we're exploring today. This isn't just another corporate transaction. No, this is a total watershed moment in the history of the Indian pharma sector and a huge transformative shift in the global competitive landscape.
Okay, let's just dive right into it. The big news making waves right now is that Sun Pharmaceutical Industries Limited has officially entered into a definitive agreement to acquire the US-based pharmaceutical entity Organon & Co. And get this, they are doing it in an all-cash transaction. So this is not a stock swap, this is actual cash on the table. By pulling the trigger on this, India's largest drug maker is effectively doubling its scale overnight. For anyone who follows the mechanics of global business, or really any equity research professional, this transaction is an absolute textbook case study.
Now, to truly grasp what Sun Pharma is doing here, we need to quickly touch on a few technical terms analysts love to throw around: inorganic growth, balance sheet reconfiguration, and therapeutic diversification. Let's break that down. If organic growth is like, say, buying bricks and cement to painstakingly build an addition to your house over years, inorganic growth is basically just buying the massive, fully built house next door to instantly double your property size. You immediately get their bedrooms, their plumbing, and in this case, their therapeutic diversification. That just means acquiring totally new types of medicines and treatments that you didn't have before. But of course, you also inherit all of their problems, which forces a complete reconfiguration of your own financial foundation. Keep in mind the expected closing for this massive deal isn't until early 2027, because buying the proverbial house next door, well, it isn't quite as simple as just handing over the keys, especially not in a highly regulated global environment. This timeline means we really have to look closely at the financial mechanics, the strategic rationale, and all the inherent execution risks that come with such large-scale cross-border mergers. A lot can happen between right now and early 2027, so understanding the foundation of this deal is absolutely crucial. Let's look at the actual architecture of how this is all going down. Any good assessment of a merger starts with the deal's structure. Sun Pharmaceutical Industries isn't just reaching directly across the ocean. Instead, they are acting through their US-based, wholly owned subsidiary Sun Pharma America, Inc. It's this specific US entity that has formally agreed to step up and acquire all outstanding shares of Organon. And they're buying those shares at exactly $14 per share. In cash. I want to repeat that. No stock exchanges, no convoluted equity trades, just $14 of cold, hard cash for every single outstanding share of Organon. To put that $14 into context, we have to look at the premium. This price actually represents a 24% premium over Organon's closing price on the Friday right before the announcement. In the acquisition game, you pretty much always have to pay a premium to convince current shareholders to hand over their stock. And a 24% bump over the previous Friday's close, that is a very solid, very compelling incentive for anyone holding Organon shares.
But here is where it gets really interesting. While it's a 24% premium over the immediate Friday close, it represents a staggering premium of over 100% relative to the stock's valuation at the start of April 2026. Basically, if you were holding Organon stock back in early April 2026, this $14 offer means your shares have more than doubled in value by the time this acquisition announcement hit.
Now, taking that $14 a share and calculating the total size of the deal requires us to look at enterprise value, or EV. Enterprise value is a super critical metric for analysts because it reflects the true overall cost of an acquisition. Let's go back to our house metaphor. Imagine you're buying a house. You pay the seller $400,000 in cash for the equity they own in it, but the house also comes attached with a $600,000 mortgage that you now have to pay off. The true cost, or the enterprise value, of that house to you isn't just the $400,000 in cash, it's the full $1 million. You always have to account for both the equity value and the assumption of the debt.
And this brilliantly illustrates the enterprise value of the Sun Pharma and Organon deal. The total EV sits at approximately $11.75 billion. At that $14 per share offer we talked about, the actual equity value, meaning the cash Sun Pharma is literally paying out, is about $3.99 billion. But Organon is bringing an absolutely jaw-dropping debt load of $8.6 billion to the combined balance sheet. That $8.6 billion is the massive mortgage Sun Pharma is inheriting, and honestly, it's a massive financial commitment.
What's truly fascinating here is what happens when we smash these two companies together to create pro forma or combined financials. Let's look at 2025 revenue. Organon sits at $6.2 billion. Sun Pharma, they also sit at $6.2 billion. Combine them and you get an instant $12.4 billion powerhouse. Because of this, their global ranking literally rockets from outside the top 50 straight into the top 25. On top of that, their global footprint expands from 100 countries up to 150 countries, and their innovative medicines portfolio gets a nice boost from 20% up to 27%. That is what you call strategic realignment in action. To understand how analysts value this newly combined powerhouse, we need to check out another crucial metric: adjusted EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. Let's simplify that. Imagine you're running a lemonade stand. EBITDA is basically all the cash left in your jar at the end of the day from selling lemonade, before you have to pay the government their taxes, before you pay the bank interest on your loan, and before you set aside money to buy a new pitcher to replace your old one. It's just a pure measure of the cash your business operations are generating. Organon's adjusted EBITDA is $1.9 billion. Sun Pharma's estimated adjusted EBITDA is also $1.9 billion. Together, they create a pro forma combined adjusted EBITDA of roughly $3.8 billion.
So the really crucial point here is how the market actually values that cash-generating ability. If you're an equity research associate analyzing this, you'll see that the valuation multiples applied to this deal are actually surprisingly conservative. First off, the deal values Organon at just 1.9 times its sales.
This conservatism becomes glaringly obvious when we start comparing EBITDA multiples. That $11.75 billion enterprise value means Sun Pharma is acquiring Organon at approximately 6.2 times its calendar year 2025 EBITDA. Now compare that directly against its industry peers. Viatris is valued at 7.04 times its EBITDA, and Teva is sitting way up at 9.86 times. Clearly, Sun Pharma is snagging Organon at a pretty notable discount.
To see just how deep this discount actually goes, let's look back at some historical pharmaceutical transactions. Compare the Organon deal's 6.2 times multiple against major historical industry bids, like Blackstone's previous interest in Cipla. Those benchmark deals saw valuations in the range of 12 to 16 times EBITDA. That is double, or even nearly triple, the multiple Sun Pharma is paying here.
Now, to understand why this matters to you and why this massive discount even exists in the first place, we have to look at the market's fears. Why is Organon so quote-unquote cheap relative to its peers in history? Well, the discount directly reflects two massive concerns: high leverage and stagnant growth. Remember that shocking $8.6 billion debt mortgage we talked about earlier? That high leverage is frankly terrifying to some investors. You combine that massive debt with business momentum that is basically flatlined, that's the stagnant growth part, and you get a heavily discounted valuation. The market is absolutely pricing in the danger here.
Which brings us to the ultimate question we have to ask. Can Sun Pharma truly turn around Organon's stagnant growth through integration discipline and revenue synergies? Look, Sun Pharma is betting $11.75 billion that their management team can absorb that debt, trim the fat, and spark cross-selling across 150 countries. It is a bold, high-stakes gamble that will undoubtedly redefine the global pharmaceutical landscape. Whether they succeed or succumb to the weight of that massive debt load, well, that's the story we are definitely going to be watching closely as we approach 2027. Thanks so much for joining me on this explainer, and I hope you leave today with a much clearer picture of the anatomy of this massive deal.
Welcome to this explainer. Today, we're diving into the absolute masterclass that is Sun Pharma's corporate evolution. If you've ever wanted to understand how a massive pharmaceutical company completely reinvents itself from the ground up and then ultimately doubles its size, well, you are in exactly the right place. So let's kick things off with the multi-billion-dollar question. How exactly does a pharmaceutical giant essentially double its entire footprint overnight? Throughout this explainer, we're going to be framing Sun Pharma and Organon as the two main characters in what is truly a fascinating financial story. We'll be digging into the exact numbers, the dates, and the strategic playbook that makes this one of the most interesting corporate maneuvers in recent history. Section 1. Sun's Specialty Pivot, Specialty 2.0. To really grasp the magnitude of this Organon deal, we've got to look back at the turning point. Historically, Sun Pharma built its empire as an absolute generics powerhouse. They were leveraging incredibly cost-efficient manufacturing in India to just dominate international markets. But as things usually go, the United States generics market eventually faced intense pricing pressure and commoditization. This completely forced Sun Pharma to pivot toward a brand new master plan they dubbed their Specialty 2.0 strategy. Instead of just turning out cheap generics, they shifted their focus toward higher-margin specialty products, very specifically targeting dermatology, ophthalmology, and oncology. Now, you might be wondering what commoditization actually means in this context, and it's absolutely crucial for understanding why they pivoted. Think of generics commoditization kind of like selling plain bottled water at a crowded stadium. When literally everyone is selling the exact same water, the only way you can win a customer is to be the absolute cheapest on the shelf. The product becomes so common it's distinguished purely by price. That's a brutal race to the bottom, and it's exactly the trap Sun Pharma wanted to escape with their Specialty 2.0 strategy. Section 2. Strategic Acquisitions, a Legacy of M&A. To pull off this massive pivot, Sun Pharma utilized a very specific, repeatable acquisition template. They have a really well-documented history of buying two types of assets. First up, distressed assets. Think of buying a distressed asset like buying a fixer-upper house at a massive discount, and then extracting all that hidden value through rigorous integration and renovation. Second, they utilize tuck-in acquisitions. These are usually smaller, super-targeted purchases. Imagine buying the vacant lot right next door to expand your yard, rather than packing up and moving to a whole new city. It's a strategic addition designed to perfectly build out an existing pipeline. Let's map this out chronologically, because this template started way back with the pivotal purchase of Taro Pharmaceutical Industries in 2007. What's crazy is this integration was only fully completed in 2024, when Sun acquired the remaining 21.52% stake for approximately $348 million, which finally led to Taro's delisting from the New York Stock Exchange. Then, jumping to 2014, they made a massive, bold move, acquiring Ramboxy Laboratories for $4 billion, firmly establishing Sun as the undisputed leader in the Indian market. And in the years leading up to right now, they really focused on those smaller tuck-ins, the 2023 purchase of Concert Pharmaceuticals for $576 million, and straight up to March 2025 with the acquisition of Checkpoint Therapeutics for $355 million. Those recent sub-$500 million tuck-ins weren't just random purchases. They brought highly specific, incredibly valuable drugs directly into Sun's oncology and dermatology franchise. From the Concert deal, they gained the JAK inhibitor Leqselvi, chemically known as deruxolitinib, for alopecia areata, which importantly scored FDA approval in early 2025. And from the recent Checkpoint deal, they added unloxetide, or cozabelimab, which is an FDA-approved anti-PD-L1 treatment for cutaneous squamous cell carcinoma. But here is where our story shifts gears entirely. The upcoming Organon deal represents a massive, company-doubling consolidation that is a total departure from these smaller tuck-in purchases. Section 3. The Organon spin-off, Merck's Legacy. But here's where things get super interesting, with the introduction of our second main character, Organon & Co. Established as a totally independent entity in 2021, it was actually created as a strategic spin-off from the pharmaceutical giant Merck & Co., which, by the way, is known as MSD outside the US and Canada. The entire reason Organon was designed and spun off was simply to house Merck's legacy products, their biosimilars, and their women's health assets. By sweeping all of these out into Organon, Merck was freed up to focus purely on its high-growth oncology and vaccine businesses. Section 4. Portfolio Leadership, Market Dominance. So what exactly is Sun Pharma getting in this deal? Just imagine a world map lighting up right now with 140 different countries. That is the staggering, mind-blowing scale we're talking about here. Organon's portfolio consists of over 70 different products sold across those 140 countries worldwide. This isn't just tweaking a pipeline, this is immediate, dominant global reach. Organon is bringing three massive pillars of strategic value to the table. First is women's health. Organon is already a global leader here, heavily anchored by Nexplanon, which has a long-acting reversible contraceptive or LARC implant. Post-acquisition, Sun Pharma instantly becomes a top 3 player globally in this segment, a market known for high patient loyalty and super stable demand. Second is biosimilars. Sun literally catapults to the number 7 position among global biosimilar players in a market that's growing at roughly 13% annually. And third, established brands. These are legacy products, often referred to as value brands. While they might be facing stagnant or even slightly declining growth, they represent a low-risk segment that provides incredibly reliable, steady cash flow. Let's hit pause on that word biosimilars for a second to really grasp what Sun is getting their hands on. Think of biosimilars kind of like the highly complex, scientifically rigorous, store-brand version of a blockbuster biological drug. They basically offer a lower-cost alternative to major biologics that have finally gone off patent. By scooping up Organon's platform, Sun gains immediate, massive scale in a market that, as we just saw, is expanding by 13% every single year. Now, what about those legacy established brands and their steady cash flow? Well, they directly support the combined entity's debt servicing capabilities. In plain English, debt servicing capability is just a company's ability to generate enough steady cash to comfortably pay off its loans. Think of those established value brands as having a reliable, guaranteed monthly income from a rental property. That steady, totally predictable cash is what's going to easily pay the new, giant mortgage that Sun Pharma had to take out to fund this massive acquisition. Section 5. Revitalizing Dermavant, a troubled asset. To figure out how Sun Pharma is going to unlock hidden value from this whole deal, we have to look at a very specific piece of recent history. In 2024, Organon made a major bet. They paid a staggering $1.2 billion to acquire a company called Dermavant. This was a massive, high-stakes investment aimed at securing a specific high-potential asset for their dermatology portfolio. But here's the catch. The primary asset from that $1.2 billion deal ended up generating only $128 million in 2025 sales. It severely fell short of Organon's internal targets. Honestly, this is the absolute textbook definition of a distressed asset, a high-priced acquisition that completely failed to deliver the expected financial results. So how is Sun Pharma going to fix this mess? Well, that underperforming asset is called Vtama, or tapinaroth. It's a non-steroid cream for plaque psoriasis and atopic dermatitis. But here's the brilliant part. For Sun Pharma, Vtama isn't a failure at all. It's practically a perfect strategic fit for their existing specialty dermatology business. Remember, Sun already successfully markets huge dermatology drugs like Ilumya and Winlevi. They're going to take their deep, proven expertise in navigating the dermatology market and use it as the primary driver to completely revitalize Vtama's commercial performance. They're basically taking the ultimate $1.2 billion fixer-upper and applying their legendary renovation skills. Which leaves us with a really fascinating final question. We've seen how Sun Pharma evolved from churning out cheap generics to their high-margin Specialty 2.0 strategy. We've tracked their chronological history of buying distressed assets and perfectly tucking in new pipelines. But is Sun Pharma's legendary acquisition template going to be enough to seamlessly absorb a company of Organon's massive 140-country scale? Can they actually turn that $1.2 billion Dermavant misstep into their biggest victory yet? It is a high-stakes financial story playing out right before us. Thank you so much for joining me in this explainer, and definitely keep your eyes on how this massive integration unfolds. So, let's just dive right into this by asking the ultimate real estate question, but, for the corporate world. Is taking on an eye-watering $8.6 billion in debt ever a good idea? I mean, imagine you're completely debt-free, your bank account is literally bursting with cash, and then suddenly, you decide to sign up for the absolute biggest mortgage of your life. Well, that's exactly what's happening in the pharmaceutical industry right now, and honestly, the numbers here are absolutely fascinating. Welcome back to our explainer. Today, we're looking at the anatomy of a deal, decoding Sun Pharma's big buy. All right, so we're going to start by looking at the total purchase price of the estate that Sun Pharma is buying. Now, from the perspective of an equity research analyst, modeling this out is easily the most complex part of the whole shebang. And why is that? Well, because Sun Pharma is making this monumental shift. They're going from a really comfortable net cash position to a significant net debt position, all to fund a massive $11.75 billion enterprise value. You can kind of think of this next part as the down payment, right? Out of that massive total price tag, Sun Pharma has to finance a $3.99 billion equity portion. And how do you even pay for a nearly $4 billion down payment? Well, you split it. They're funding this using a mix of $2.0 to $2.5 billion in internal accruals, so think of that as just emptying out their own corporate savings account. And then they're combining that with $1.5 to $2.0 billion in committed bank debt, which is essentially just taking out a giant new loan. But here is where it actually gets really interesting, and frankly, where credit analysts start to sweat just a little bit. Because that $3.99 billion equity portion, that's really just getting the keys to the front door. The true financial burden, the real weight on the balance sheet, is the hidden cost of the house they just bought. See, by acquiring Organon, Sun Pharma isn't just buying their products and their revenue streams. No, they are inheriting Organon's staggering $8.6 billion in existing debt. And this completely reconfigures Sun Pharma's financial reality basically overnight. Suddenly, a company that has historically been incredibly cash-rich is just taking on this colossal liability. So, when you finally merge these two companies together, you end up with a pro forma net debt to EBITDA ratio of approximately 2.3x. Now, if you're wondering what that actually means in the real world, think of it exactly like a household's debt to income ratio when you're applying for a new mortgage. It's exactly the metric the bank uses to see if you can, actually afford the monthly payments. And to really understand that 2.3x ratio, we have to talk about EBITDA and FCF. That's earnings before interest, taxes, depreciation, and amortization, and free cash flow. But in layman's terms, this is basically the household's predictable take-home pay that actually covers the mortgage. Now, a 2.3x ratio is definitely higher than Sun Pharma's historical average. But here's the thing. In the pharmaceutical industry, cash flows are remarkably stable and predictable. You can pretty much always count on people needing their medicine, right? And that's exactly what makes taking on this much debt manageable for them. So we're looking at a pretty stark contrast here. Sun Pharma's history has very often featured negative debt, just because of their cash-rich status. But their combined future? It's this 2.3x leverage ratio. However, Sun Pharma's management is super confident about this. They've emphasized that the combined entity's EBITDA and free cash flow are actually set to nearly double. And that gives them the necessary liquidity for what they're calling rapid deleveraging. Basically, they're planning on aggressively paying down this mortgage in just 2 to 4 years after the deal officially closes. Now, to understand why all of this matters to you and really to the wider market, let's go back and look at that household budget. Because ultimately, a buy or sell recommendation from any equity research desk really hinges on one simple question. Does taking on this giant mortgage actually make Sun Pharma richer or poorer month to month? The magic word Wall Street is looking for here is accretive. When an analyst says a deal is accretive, it just means it increases the company's earnings per share, or EPS. You can think of EPS kind of like slices of a pizza. If the deal is accretive, your specific slice just got bigger and richer. Or to stick with our mortgage metaphor, it's like buying a massive house, but immediately renting out the guest house so your overall monthly income just goes up right away. And according to equity analysts at HDFC Securities and Novama, the Organon acquisition is expected to be significantly accretive from the very first year. Okay, so the ultimate scorecard for this is the pro forma estimates for fiscal year 28. Get this. Revenue accretion is up 80%. EBITDA accretion is up 82%. Profit after tax, or PAT, is up a really impressive 27%. And the pro forma EPS accretion is over 40%. Now, the absolute crucial point there is that 27% jump in profit after tax. That is remarkably impressive when you remember they are paying huge interest expenses on that brand new $8.6 billion debt. But there is a catch. Did you notice that gross margin impact at the bottom? Minus 960 basis points. Yeah, a drop of 960 basis points is exactly what analysts call dilutive. To explain this simply, imagine you have a high-paying day job, right? And then you take on a side hustle that pays a lower hourly rate. Your average hourly rate drops, and that's dilution, but you're still taking home way more total cash at the end of the week. This 960 basis point drop is happening because Sun Pharma is merging Organon's legacy and branded generic drugs, which naturally have lower profit margins, with Sun's existing higher-margin specialty business. So how exactly do they prevent that lower margin from just ruining the whole deal? Well, it's a three-step process. First, they rely heavily on operating leverage, which basically means producing more products without proportionally increasing their costs. Second, and this is massive, they anticipate extracting $350 million in cost synergies. So that means finding overlapping costs in the two companies and just cutting them out completely. And third, by doing all of this, they expect to completely neutralize that gross margin drop. So they keep the overall EBITDA margin stable and actually improve it by 10 basis points. Which brings us to our final question. Sun Pharma has successfully engineered a way to take on $8.6 billion in debt, double their cash flow, and increase their earnings per share by over 40%, all while planning to pay off the mortgage in just 2 to 4 years. I mean, it's a literal masterclass in balance sheet reconfiguration. But the real world isn't always as clean as a pristine financial model, is it? Will this giant, highly calculated mortgage pay off the ultimate dividend and solidify their market dominance over the next 4 years? Or will unforeseen costs make this heavy debt a burden just a little too far? We'll definitely continue to track exactly how this plays out. Thanks for joining me on this deep dive, and I'll catch you in the next explainer. Welcome back to The Explainer. Today, we're looking at a massive maneuver in the global healthcare space. And to really wrap our heads around this, I want you to think of it kind of like a high-stakes role-playing game. Our main character in this story, Sun Pharma. They're an industry heavyweight, and right now, they're embarking on an epic quest. Their mission is to level up their global stats, patch up some strategic vulnerabilities, and acquire the ultimate power-up by joining forces with another major player, Organon. We're going to break down the actual equity research behind this colossal acquisition to show you exactly why this move is an absolute game-changer. Here's our chronological blueprint for today's explainer. We've got 1. Logic beyond arithmetic. 2. Diversifying revenue. 3. The hidden gem in China. 4. Bridging the biosimilars gap. And 5. The specialty 2.0 transformation. Let's get into it. Section 1. The logic beyond arithmetic. The core thesis of this entire deep dive is that the logic of this deal absolutely transcends simple arithmetic. For Sun Pharma, acquiring Organon isn't just about taking two company ledgers and adding their revenues together, right? That's just basic math. This is about strategic evolution. By acquiring Organon, Sun Pharma is actively addressing some very specific historical strategic vulnerabilities, all while kicking the doors wide open to massive new avenues for global growth. It's a precise, calculated strike. Section 2. Diversifying revenue and reach. Okay, let's dive into this. 150. That is the number of countries the newly combined entity is going to operate in. Imagine a global map, and right now, picture 150 different nations rapidly lighting up. That is the new, vastly expanded geographic footprint Sun Pharma immediately commands on day one of this integration. But let's refine that focus a bit, because not all of those 150 countries are created equal. Within that massive footprint, this deal gives them a seriously fortified presence in 18 major, high-impact markets. And here is exactly why those 18 major markets are so critical. Every single one of them generates more than $100 million in annual revenue. Just think about that visually for a second. Massive stacks of cash, consistently generating over 9 figures a year across 18 distinct territories. That is incredibly robust cash flow, coming from a multitude of different geographic pipelines. So the crucial point here is how this actually changes Sun Pharma's corporate DNA. Historically, analysts noted that Sun Pharma really suffered from an overdependence on just the Indian and US markets. Basically, if something went wrong in either of those two economies, Sun Pharma felt the pain acutely. By bringing Organon into the fold, that historical vulnerability is neutralized. They've essentially traded a concentrated two-pillar reliance for a vastly diversified global operational footprint. They're spreading their risk and insulating their balance sheet against regional economic downturns. But here is where it gets interesting. Section 3. The hidden gem in China. Tucked away inside Organon's portfolio is a fully established, incredibly lucrative commercial presence in the Chinese healthcare market. This hidden gem alone generates approximately $800 million in annual revenue. To give you some context on why that is so impressive, building a commercial organization in China from scratch is notoriously difficult. It is intensely expensive for foreign firms. You've got regulatory hurdles, complex distribution networks, cultural business nuances. It literally takes years and billions of dollars to get it right. Organon already did the hard work. Which leads us to this quote straight from the equity research. This deal grants Sun Pharma a direct path to sell its own specialty pipeline into one of the world's fastest-growing healthcare markets. Picture a massive, complex highway system totally gridlocked with toll booths and roadblocks. Well, this acquisition is essentially a VIP pass. It lets Sun Pharma bypass all those toll booths and merge directly into the fast lane, distributing their own existing drugs to the Chinese population using Organon's established infrastructure. Moving on to Section 4, Bridging the Biosimilars Gap. First off, let's make sure we're all on the exact same page here. What actually is a biosimilar? I want you to think of a biosimilar as a highly complex store-brand version of a designer biological drug. You know how you go to the pharmacy and you can buy the super expensive name-brand pain reliever, or you can grab the cheaper store-brand version right next to it that does the exact same thing? A biosimilar is that exact same concept, but for incredibly advanced, incredibly expensive designer biological medicines used for severe diseases. Before this deal, Sun Pharma had a very specific problem, what we're calling the biosimilars gap. They were hard at work building an internal pipeline of these biosimilar drugs, but they totally lacked the sheer global commercial scale to compete. When you looked at their industry peers, companies like Biocon or Viatris, those competitors already enjoyed massive global commercial scale. Sun Pharma was effectively bringing a knife to a gunfight. Enter Organon. Organon's portfolio brings immediate, undeniable credibility to Sun Pharma. Specifically, they bring a key asset, a drug called Hadlima. Now, Hadlima is a biosimilar to a drug called Humira. And if you follow the pharmaceutical industry at all, you know that Humira was one of the biggest, best-selling blockbuster drugs in the entire world. By acquiring Organon, Sun Pharma instantly owns the rights to this highly lucrative store-brand version of a massive blockbuster. To understand why this matters to you, and why equity analysts are absolutely buzzing about this, you really need to understand the patent cliff. Think of a patent cliff like a timer running out on a company's exclusive monopoly over a drug. When that timer hits zero, the floodgates open to competitors. And over the next decade, a massive number of blockbuster biologics are going to hit their patent cliff. Because all those designer drugs are losing their monopolies, the demand for biosimilars is absolutely going to explode. And thanks to this single acquisition, Sun Pharma doesn't just enter the race, they are instantly propelled into a top 10 global ranking in this crucial segment. In fact, they officially land in 7th place globally. This isn't just a patch for a vulnerability. This 7th place global ranking in biosimilars is going to serve as a vital, high-octane growth engine for the next decade. Which brings us to Section 5, the Specialty 2.0 transformation. Sun Pharma has been aggressively pushing a corporate initiative called Specialty 2.0, which is all about shifting their focus away from traditional generics and toward innovative medicines. Why do equity analysts love this so much? Well, let's use a metaphor. Traditional generics are kind of like selling plain black coffee. Everyone sells it, it's cheap, and the profit margins are tiny. Innovative medicines, those are like selling a patented, high-margin, secret recipe frappuccino. Only you can sell it, you can charge a premium price point, and you enjoy a much longer period of market exclusivity. Naturally, you want your business selling more frappuccinos, right? The financial impact on that specific goal is crystal clear. The key metric analysts watch here is the percentage of revenue derived from those high-margin innovative medicines. Sun Pharma's pre-deal projection for fiscal 2025 was about 20%. But on a pro forma basis, which is really just a financial sneak peek where you combine the two bank accounts together, acquiring Organon pushes that share up to 27%. That is a massive leap in profitability, and it's the exact kind of high-margin growth Wall Street absolutely loves to see. So let's step back and look at the whole board here. Sun Pharma perfectly executed their chronological blueprint. They diversified their massive geographic reach across 150 countries. They bypassed the toll boost to secure an $800 million hidden gem in China. They rocketed to 7th place globally to bridge the biosimilars gap. And they successfully pushed their Specialty 2.0 margins from 20 up to 27%. It is literally a masterclass in strategic acquisition. But, in the ruthless world of global healthcare, the game never truly ends. So I'll leave you with this to think about. With the Organon deal in the books and the Specialty 2.0 transformation secured, what strategic vulnerability will Sun Pharma target next?